Okay. Good day, traders. This is Dennis Wilburn with the Active Trend Traders. Welcome to a series of videos, free videos, that I call Tech Tips that covers some aspect of technical analysis that I want to share for free with the members that are out there across the universe, across the globe. Anyway, we're going to have some fun with this. If you like the tech tip that we provide, please give us a thumbs up. Please subscribe to us on our YouTube channel, Market Tech Talk. And if you want to dive deeper into what it takes to be an active trend trader, you can always follow us on our website. So let's get on with the video. Aloha and God bless.
Traders, this is Dennis with the Active Trend Traders. I want to say welcome to today's tech tip. And what is today's tech tip? Today's tech tip is seasonality. 2017, an update. We got started working on seasonality a little bit going into in 2016, and as we expanded to look at various ETFs and all that kind of stuff, and we found this just remarkable aspect of all entities is that they tend to run with a particular seasonality to when they tend to, increase in value, when they can decrease in value. And so it kind of proves the old, ancient text that said, for everything there is a season. And so let's get on with a really quick presentation here. All materials presented are for training purposes only. Traders should always paper trade any new method prior to the risk of their own personal capital. I became interested in the aspect of seasonality, like I said, several years ago. One is, as I was doing background research on the IBD 50, the first IBD 50 list of every year, I noticed that there was a certain repeated pattern that would happen during the year, where the first IBD 50 list of the year would, increase in value up to a certain point in the year, then basically sell off into, the midsummer time frame, and then, get on to another little upswing. And oftentimes your biggest move would come somewhere to where on the IBD 50 stocks between April and going in June to July, and then again in October. And so that got me to research a little bit more of aspect of seasonality. And then I started looking at gold. Gold definitely shows seasonality. And so let's just go a little highlight here on what we're looking at and what we're seeing so far in 2017. Seasonality. Okay, market timing by itself is based on short-term price patterns and trying to pick market tops and bottoms. Seasonality is a little bit different. Seasonality is about anticipating how the market will behave in a given time of the year and taking a position as the change occurs. Seasonality appears in stocks, in commodities, in nature. It's just, there's a rhythm, underlying rhythm to what's going on in the market, to what's going on in life, and being aware of it allows us to tap into certain points in the year where it's where there's a higher probability of the market going up for at least a little while. And so, trying to answer the question, are there better times of the year to be buying into the market than others? And the answer to that is yes. By understanding the ebbs and flow of seasonality, traders can better position themselves to take advantage of the buying and selling opportunities. Remember, seasonality reflects a tendency. It's not necessarily the same every year, but there's a tendency, and appears to act like an undercurrent each year. So while the chart of the individual entity that we follow may, it's clearly, it doesn't look the same from year to year to year to year. There is some underlying current that there are points in the year where we can expect price action to either escalate or de-escalate or fall based on these timings. And so each year is different, each year is the same. So we have to remember, ultimately, we have to trade the charts. So index seasonality effects. Well, first there is a monthly effect. Okay, clearly, typically January. This chart here reflects what basic month and how they do each year. And this covers from 1926 to 2004. And what it shows is that basically September is typically the worst performing month of the year. We're doing this recording in August of 2017. And one of the other things to remember is that August is also typically the month that has historically the greatest volatility. So we're having the greatest volatility followed by the worst month of the year. But the cool thing about that is that sets us up for potential buying opportunities in October, where oftentimes October, November, December, January, sometimes sliding into February, are the better times of the year to be invested. There's also days of the month seasonality effect. Recognize that is a short season, but there's better times of the year to be buying than others. Days of the week. Monday's not really that great of a day to be buying, but Tuesday, Wednesday, better days. Thursday, a little bit off, and then Friday is a good day, or the return on Fridays is pretty good. So, how is seasonality working for 2017? Well, at the Active Trend Traders, we track basically 7 entities. The 3 of them are the tracking indexes that we track on a regular basis, which is the SPX, the NASDAQ 100, and the IWM, which is the Russell. And these are the non-leveraged ETFs that follow each one of these. Adjoining them, over here are the 3-time leveraged ETFs: UPRO for the spiders, TQQ for the Qs, which is the NASDAQ, and TNA, which is for IWM, and the Russell. One thing that we know with regarding seasonality, I'll cover that when we get to the chart. Well, look at that. Isn't that great? There we go. So let's get to the chart here. And then additionally, we cover 4 premium leveraged ETFs on select industries and commodities. We did some research to look back to say, okay, which of the entities have the best performing, when I say best performing, the most stable performing leveraged ETFs. How many? Which of them have good option exposure if somebody wants to trade options, and that's what we take a look at. And then basically, then once we established our stable of ETFs we're looking at, now we just have to pay attention to apparent buy points. So how has it done in 2017? Okay, here's a chart of the S&P showing seasonality. Chart of S&P showing seasonality. The pink line shows for an average year, and that's what we primarily focus on. We'll just focus on the average year. The blue line is basically a post-election year, which we, of course, are in a post-election year. And what we're seeing in 2017, which post-election, we're seeing some similarities and some differences. The S&P is following kind of along the course of the pink line, which is just an average year. And it's basically got into August now, and it's kind of pushing sideways. And we expect it to fall off a little bit into the September timeframe, and then get set up for a nice move towards the end of October, the Christmas or Santa Claus rally, a lot of people call it. But tends to be, a move of, on average, over a 59-year period, on average, from the last of October into the end of December, the S&P tends to run about 8%. Just knowing that information, running 8% during that period of time, is great information to know, especially if you are a option trader with the SPYs, or leverage ETF trader with UPRO in this case. And I'm going to only cover S&P. Let's take a look at what has taken place. And what I've done is we have the S&P up here on the top, showing its seasonality, and I've matched up a chart of UPRO, which is a 3-time leveraged ETF of the S&P, and this is the chart that it is put in for 2017 as of the 21st of August 2017. So I want you to take a look here, and again, the chart isn't exactly the same, but these periods just before on the historic chart, before price action would take off in the S&P, also highlighted, this is that undercurrent I was talking about, also highlights areas of consolidation on the UPRO chart, which then in fact led to a tradable rally over the over the coming days. And so this is a daily chart down here on the bottom. And so there is the first tick up. We got a reversal signal here off the 20-day moving average after some of these initial signals here. And the S&P ran up 19.3% in 29 days. We get another one over here. In 10 days, the S&P runs up 9.2%. That was 19.3% in 29 days over here. And then last here recently in July, which corresponded to the area here in July where we get a little bit of a tick up, 9.6% in 21 days. Now, I'm not saying, clearly we are not going to be able to pick up right exactly at the bottom and sell exactly at the top of any entity. However, if we, since the active trend trading system, and we watch for these trigger points, we just estimate, if we can capture half of these moves, half of these individual moves on things like, on with UPRO, well, but by capturing half of these 3 moves, it would have resulted in a compounded rate of about 20% on being exposed to the market for, there's 39, so about 60 days. 60 days of market exposure would have resulted in about a 20% gain if you took advantage of compounding. And so that's one of the things that we just want to keep an eye on and remember, and that's what we do. So as the update goes, is the historic data on the S&P corresponds and shows the undercurrent that on UPRO led to some nice moves up in both areas throughout 2017 so far. It'll be interesting moving into the rest of 2017. In the October timeframe, are we, right now, in the August-September timeframe, are we actually going to get the pullback? Is that pullback currently underway, as we see right here, as we pull back all the way to the 100-day moving average on the UPRO? Is that going to be what leads to the bounce that historically tends to happen in the October timeframe? And what kind of a run will that go on? What we say, 8% is, or not, but going in, 4% typically through the last 3 months of the year. Well, if you're doing a 3-time leverage, that equates to about a 12% move. And so that's what we're looking forward to moving into the end of the year. So what about the summary of seasonality? Well, one, every year is different, but it's the same. Seasonality seems to be an undercurrent, and we get this recurring theme, not only on the S&P, but also on the NASDAQ, also on the Russell, and also on the commodities and the industries that we in fact track. 2, tendencies are not exact, but they can provide us with an edge. 1, and they help us to understand when the probabilities of a move in the positive direction are greatest. They help us shape our expectations of where price action is likely to go. So it gets us in the ballpark of when positive moves tend to happen. So as Mike Traeger likes to say, this is one of his yogiisms, it doesn't happen every time, but it does happen all the time. So, hey, for active trend traders, with our system that, our premium service, we do provide these ETF triggers. It's based on a strong limited watch list. We're not going to be watching thousands of ETFs. We've got it cut down and limited to a really good stable of 7 entities that we watch, 3 of them being the indexes. So it's a strong limited watch list of index, industry, and commodity ETFs. The list is limited to 7 entities for clarity and simplification. We just want to keep it clear and simple. For premium members, when we get our triggers based on the active trend trading rules, we send out a text and an email alert showing what orders that we're currently placing. And so some people like to just parallel trade with us. They are not recommendations whatsoever, because what we do is for training purposes only. So trading just the ETFs, greatly reduces the stress of trying to find a stock to trade. Basically, what we need to do is just simply wait patiently for the signals, and the signals come. Going back and reviewing and doing back studies, over multiple years, sometimes going back 15, 20 plus years, the signals come, and they tend to come every year. I think one of the things that is most evident in that aspect of the market moves and the timing of the market moves, back in 2008, after the market had sold off dramatically, did you realize that S&P, sometime in the, I want to say in the late October or early November timeframe, went on a move and moved in excess of 23% prior to the end of the year. Now the S&P was down dramatically for the year. I mean, it was in the double digits to the downside. But even though the market was selling off, we were in a bear market, there was a very large, powerful move within that the trading the ETF system with active trend trading would have helped a person get into. So if you like these tech tips, here's some of the future topics we're going to be covering: how to use the 8-day moving average for objective entries and exits, and then when is it right, or is it ever right, to go all in? Are there certain setups where you want to basically recognize that if I go in with a larger portion of my portfolio, of my capital, the chances are I'll lose a little, but the other chances I will gain a lot. There are certain setups that are more, support that kind of a move than others. Option stocks are both, and more. And if you have any suggestions on topics you would like to see on tech tips, please shoot me an email. You can reach me at dww@activetrendtrading.com. And until later, God bless everybody. I hope you enjoyed today's tech tip. Hey traders, this is Dennis. Hey, if you act prior to the end of August 2017, you can take advantage of a 40% savings on a premium membership to Active Trend Trading. Just give her a try. Thanks.